Welcome to the Fast Five by Fear and Greed. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
Sean, today, in just 5 minutes, we want to find out what investors should be thinking about in terms of US stocks. Now, remember, this is general information only, and you should seek professional advice before making investment decisions.
Wall Street, Michael, as you know, is home to some of the biggest and most well-known companies in the world. Josh Gilbert is a market analyst at social investment network eToro. Josh, how did investors fare on US markets last year, 2022?
Yeah, I think that's a question that can probably have a couple of answers. I think, mainly investors did struggle, right? We saw the S&P 500 drop as much as sort of 25% in 2022. Inflation, rising interest rates sent markets lower. Valuations were crushed. Some of the biggest names, Meta, Netflix, etc., really, really struggled. However, it wasn't completely all doom and gloom. We still had assets that performed well. US energy stocks were some of the best performing assets in 2022. And we also saw some really strong performance from high yielding dividend stocks as well. So I think it just depended how investors positioned their portfolio. But if we're being just, completely frank, most of the reason why investors turn to the US is for tech. And unfortunately, tech didn't have a very good year in 2022 and really came under pressure.
Okay, crystal ball gazing time, Josh. 2023, what do you reckon will happen on Wall Street? It's particularly tech.
So the sort of setup right now is we've got a view here for lower inflation, lower interest rates, sort of a global economy that's starting to cool. But we sort of see that volatility will kind of remain high because we're sort of really not sure of what the Fed are going to do. Yes, we sort of saw, a sort of slowdown. It was a bit of a pivot, wasn't really a pause. We're still sort of waiting to sort of really get that full picture of when we're going to get that pause in 2023 and when we're going to probably see, rate cuts coming through potentially at the end of the year. But I think forward-looking investors will see those sort of that mix of inflation coming down and interest rates sort of slowing down as the footsteps for the next sort of bull market. And I think that could, be on the horizon maybe late in 2023. And as I say, that's sort of around the time we would expect the Fed to start cutting rates. So I think what we're sort of seeing here is we're preparing for that next cycle. We're slowly sort of re-risking back into this market for tech. And I think we'll see some positivity with those valuations that have come down dramatically.
Are there any specific companies that you think may do okay over the next 12 months or so?
Well, I think ultimately, we're going to start to look less defensive. We don't want to sort of really completely take away the defensive assets because we sort of want to stay defensive for risks that we believe that could still come. And again, we are ultimately still seeing inflation in the US at 7.1%, and we've also got interest rates at 4.5% or so. So I think we've got to stay defensive, but we don't also want to overlook, say, maybe some old world sectors, banking. Oil. I think these are two of the sort of cheapest sectors in the market. They're still sort of benefiting from decade high interest rates and oil prices sort of staying high respectively. But as I mentioned, slightly defensive, select technology names, think big tech, huge balance sheets. We're never going to stop advertising on Google. I think Netflix are introducing a really fantastic advertising model there. But again, drawdown is massive this year. And again, some of those disruptive tech names that have had those valuations crushed this year, I think are starting to look a bit more attractive to investors.
So much will depend on earnings season, like Wall Street earnings season, which is next month, February, and then kind of 3 months later, because that is something that could derail markets, is that earnings are compressed more than analysts think.
Absolutely. I think that is the biggest risk as we head into 2023. And it's that race between sort of high inflation and the damage that we get to the global economy with a recession sort of hanging over us in 2023. And as I say, earnings have been relatively resilient in 2022. I think a lot of analysts believe that they were going to come down more than they did. And as you say, a recession could sort of really derail that. But I think we're taking positivity in that we saw resilience in earnings, and that if we do see a recession, that earnings, a slowdown could be modest, and that sort of lower valuations that we do have should provide some relief to lower earnings. So sort of right now, we've got sort of earnings growth at 5% for the S&P 500 in 2023. So I think that's something to keep in mind and to keep an eye on. But I agree, that is going to be the risk heading in to later in the year is earnings.
Josh, thanks for talking to Fear and Greed.
Thank you very much.
As Josh Gilbert, market analyst at social investment network eToro. So some good news there, Michael, because whilst you wouldn't exactly say that Wall Street, we quite know what's going to happen, if rates come off, that could be good for the top companies in the world's biggest bourse later in the year.
Yeah, it could be a big year. Thank you very much, Sean.
Thank you, Michael.
Remember, this is general information only. You should seek professional advice before making investment decisions. Make sure you hit follow on the podcast. There's a new episode every day, regular business news from January 16. I'm Michael Thompson, and that was The Fast Five by Fear and Greed.